start, I think it's good that we introduce ourselves. So I'm going to start first, and then I'm going to ask MAROUEN, is it, how do you say? MAROUEN, MAROUEN to introduce himself, and then followed by Daniel. And so all of us here are on the DeFi. I myself is a co-founder and also a builder in 2 DeFi projects. One of them is the spool.fi, which is now fully DAO'd, so I'm out of it. And the other one is Fluidity Money, which we have launched, and it's basically incentives layer mechanism that is built on the blockchain. And I am also the president of the Women in Blockchain Asia. So that's it, so over to you.
Thanks. Hello, everyone. This is not my first time in Thailand, but it is my first Web3 event here, and I'm very excited to meet all the builders and investors and everybody who's associated with the space. So my name is MAROUEN. I am part of Consensys. For you who may not know Consensys, actually it's a software company. We have a lot of products that are enabling the Web3 users and builders to interact with the space. MetaMask is one of them. But within Consensys, I am really focusing on the DeFi and wallet builder segment. And so my day-to-day job is really to be connected with the top DeFi protocols, the new projects coming in, understand how they're deploying their projects on EVM, non-EVM chains, and how we can support them from a technology point of view. I personally have a background in tech, so no financial advice here, but technology advice anytime. You're welcome. Daniel.
Hi. Cool, that's awesome. So hi everyone, I'm Daniel Un, head of DeFi at the Algorand Foundation. The Algorand blockchain is actually founded by Sylvan McKelly, professor at MIT. And for the better part of since the founding of the Algorand blockchain, we have been focused on consistently low fees. And what I mean by consistently low fees is that fees that does not fluctuate and actually add to business costs. So that means that we are actually facilitating payment services providers, fintech companies, as well as consumer-centric NFT collections on launching on our chain. In 2023, we are really looking at the evolution of state proofs, and that is a zero-knowledge proof developed by Sylvan McKelly in terms of helping inter-blockchain communication. Yeah.
Cool. So I'm going to start by addressing an issue that has basically robbed the media attention in the crypto world. Yeah. And also we're going to have this bit more conversation since it's just a small group of us. Okay, so FTX, all right? I think everyone here knows what's happening to FTX, okay? And I'd like to just ask from your perspective, in the area that you're doing, okay, how the FTX fiasco, I would say, that thing has affected your industry, your organization, your company, in that sense, and then I also want you to then take a step back and then say, how do you think that too has affected the DeFi market? Because a lot of the word on the ground is that they tend to equate FTX to DeFi. And then the third one I would like you to also consider is that how would you propose that we rebuild confidence, especially in the DeFi market, in your industry following this?
You want to go first?
Yeah, cool. So I just want to say that before FTX went down, they actually cleared all of their DeFi loans first, because everything that's on-chain is actually verifiable by everyone else. So when they had a lot of bad debt, right, they actually clear everything that has to do with DeFi. So I think on that front, that's testament to how DeFi is very important. And in terms of transparency, right, that's the #1 thing that they actually tried to prevent people from finding out that they had a lot of bad debt. I would say that FTX is actually a very big loss for the industry as a whole, because we're talking about large amounts of money, right, like $11 billion lost by consumers. I think that's really, to be very frank, that's really terrible. I would say that FTX is actually a financial intimidation story. And what I mean by that is, if you think about how banks or NBFIs, they kind of work, right? They take in money. In this case, I'm not going to speak about the regulatory side first, but they take in money from consumers or businesses, and then they kind of intermediate the loan, and then they lend it out. So if you look at how banks kind of fail, even in other smaller regions, right? this is actually the same story, to be very frank. So I would say that we would see, it would take quite a long time for trust to be restored, especially in what I call the CeFi, TradFi side of things, because when your money as a user goes into that company, goes into that exchange, right, you don't actually know what's happening. But of course, to that end, right, if you look at what Binance has did, they have released a proof of reserves fairly quickly. I think within 1 week of FTX falling, and a lot of other exchanges such as Kraken, etc., has actually followed suit. So I would say that it's really the flexibility that comes with the industry itself that would allow the industry and the users to kind of regain trust fairly quickly over time. Yeah.
Yeah, true. So I think FTX is also like highlights one of the big limitations of our space. So we are building the Web3 technology and economy really to promote self-custody and promote disintermediation of parties between me and you wanting to trade. Unfortunately, where the state of technology is today, it's really missing a few pieces on user experience, on user adoption, that the centralized exchanges still play a big role for onboarding the users into the space. Ideally, you would see it as actually a short journey of learning where you onboard through a centralized exchange and then you learn a bit more about self-custody and then you go and move to the DeFi space completely. So from our business point of view, our mission has always still been actually to promote self-custody, DeFi, and in a way, the FTX event is kind of a validation for the importance of such thing, the importance to have your MetaMask, to have your ledger, to have your own knowledge and comfort with certain DeFi protocols that you interact with. But unfortunately, we are linked into the same space. And so one of the biggest impacts, for example, a lot of projects are building some seriously good technology, but then they're still a bit immature when it comes to managing treasuries, to managing their investments, managing their funds. And so you see, for example, great projects with a good tech, but then they were treating FTX as a bank, right? And so a particular project that I can think of right now, when the Luna thing happened, they said, well, we will not be holding any crypto assets. So they moved everything from crypto to from tokens to USDC, right? But they kept the USDC in FTX as a bank. And this is really lack of maturity when it comes to managing your funds, managing your treasury. And yeah, it's going to be tough to bounce back. So a couple of things again. From a mission statement, this is a validation that you should probably not trust. I mean, in this space, you should not trust people who say, trust me, but trust in the software, trust in the smart contract. And that's what we're building. We are not there yet, so exchanges still play a big role, and I hope that with the regulation a little bit, with the proof of reserves, these exchanges will be a bit more resilient. But ultimately, we are trying to move people into self-custody space.
I find it quite interesting. So here's the thing. I just want to get a snapshot here on the crowd here, because there's a few words that's been thrown out, which is CeFi, TradFi, DeFi. I'm just going to stop here. Any one of you are a little bit struggling on that part, don't really have an idea of it, can you just put up your hands? Oh, good. Everybody understand that. That's great. Okay, so so I like to zero in what you mentioned about proof of reserve. My personal thought about it is that, yes, it's a good step, but it's a snapshot given at a certain time on a selection of coins that doesn't necessarily represent the health, the wholesale health of the treasury. In other words, I think it's a good step, but I don't think it's a step that stretches far enough and will actually restore any form of sustainable confidence. That's my opinion. I also like to explore, okay, the next one, which I observe, is that a lot of this proof of reserve that is coming out, they are actually coming out and validated, so to say, by RegTech companies like Nansens, Elliptics, and all that, okay? Are we actually moving our mistrust from a centralized organization and placing our trust to another unregulated, centralized organization?
This is a tricky one. So I think this has been mentioned a little bit in one of the previous panels, which is the benefit of blockchain is that the data is there, right? There is a wealth of transparency and data that is sitting on the chain. And in traditional finance, if there is a misappropriation of funds or if there is fraud, it takes us actually weeks, days, months to see the effects of what's happening. But then in blockchain, the benefit is that if you know what you're looking for, the data is right there. Now, the challenge with data is indeed that it's not accessible to everybody. Like, I can't go and find out what are the latest movement on a particular token and have a nice dashboard that collects the data, visualizes it. And that's what probably Nansen is doing, and some other companies are doing that. But then it goes one step further, because presenting the data also matters to the sense you make of it, the way you present it. And so this is where you're mentioning, like, you're putting your trust of, like, that dashboard is giving me a perspective that is neutral maybe, or not promoting one view versus the other. I don't have a solution. I think there will be hopefully a bit more. So decentralization can happen through a few things. So first of all, having a non-monopoly on this space could be interesting. And so I personally work with a few projects that are building, they always share the same tagline, I'm building the Bloomberg of blockchain. Right? There is probably like 3 or 4 that I personally know that are building this, and this is a good thing. Like, you would have different dashboards, different views on things, and then potentially, as you see with a lot of NFT market, with exchanges, you might have aggregation on top of that. And so a project could be actually aggregating views on a certain assets from different sources, and that could be your Google or your neutral. But you're right. So I think ultimately the users have to take a bit more control in terms of, like, being skeptical of the data that are served to them, and then analyze a bit further. And for that, perhaps there is more to do on that space.
I would basically add that I think there's a lot of real businesses that services the blockchain industry. And I think this is actually a good example of where real business can actually come in. So there is a joke on crypto Twitter that's saying that, hey, you know, like, Binance has X amount of billions of tokens. But for example, they could just borrow against it and then leverage 5 times, right? So their liabilities will be 5 times more than the assets that they have on chain. Then what's the point, right? So I think that's where real businesses and real impact can actually come in from auditors, for example. So looking at how people actually audit on-chain and off-chain, I think that's really important. So when Maru was actually sharing about the on-chain initiatives, right, it's about how the geniuses that we have on the blockchain technology are pushing the frontier on digital, but on the real world, people are still, you know, kind of like lying and cheating, and I think that really needs to change. And I think that also brings in, like, the regulators and the regulatory side of things, actually.
Thank you for bringing that in. So that actually leads me to another discussion point here. And so here's the thing. From what is observing is that, okay, FTX blew out a lot of issues that needs to be discussed. And the consequence that leads to it, which is the proof of reserve and all these things, also brought up more things to be discussed. The bottom line is this, is that DeFi is actually a concept, and it's workable, and it's actually helping to open up financial inclusion and access to a lot of people, all right? But with all this thing that's happening, it's sort of like made you think about the security issues and also, of course, you know, the off-chain and on-chain and all that, okay? So that's where the traditional finance or the CeFi comes in, because they're regulated. Majority of them hold licenses. And they tend to pay a lot of attention to their onboarding, so it makes it easier for their users who have no knowledge whatsoever in terms of how to connect to a MetaMask and then connect the MetaMask to this protocol. They have that kind of technology know-how because it's their bread and butter. I speak of this is because I watched how my product, Spool, started off as essentially a DeFi product, and now is morphing into a DeFi as a service product, servicing the centralized finance. So in other words, basically, they are using more the DeFi components as a backend, as another form of yield, but not necessarily them actually moving into DeFi and actually offering a DeFi product. So I'd like to get your thoughts about that movement in terms of the products, DeFi going forward.
Yeah, sure. So I think for the attendees here, we can break it down. When you look at any DeFi protocol, there is, in its most simplistic view, two layers of it. So the first layer is really the mathematical equation of the DeFi, how it's generating revenue for the protocol, how it's generating revenue for the users, the liquidity pools, how they organize, how the assets, how they link together. And so that is equivalent today to a financial product, right? So that's your financial product. Then what you will need is you need investors to come and interact with this financial product. And this is where the tech part of the DeFi project comes in. So you're building essentially a dApp, building an application, you're building a smart contract, you're building an application, you're building an interface, you're building an onboarding for the user so they can interact with it. And this is a lot to cover, right? So if you look at most DeFi projects today, they are a team of maybe 20, 50 people at best. And so they're spread quite thin. Either they have an amazing financial product and a really bad app, I'm thinking Curve here, or actually a good app and the product is not interesting, doesn't have a lot of yield, doesn't have a lot of return. And that's where centralized CeFi and whatnot found their sweet spot. They said, well, we don't have to go and invest in particularly building a financial product. We have a highly composable library of products that are available in the space. But what we know best is how to onboard the users and give them the application layer, right? And today, that's tremendous business for them, and that's why many of the successful exchanges are doing that. But ultimately, and this is more of a selfish view on what we're doing at Consensys, and personally, we are building this industry in a way that we want that capability to build an engaging user experience to mature in the companies. And so what if we give the right tools to a DeFi project to really build a very engaging dApp? How about we give tools to the user when they come with their MetaMask? It's a no-brainer how to connect and do the transaction safely and know what you are actually doing with the protocol. It's going to take a while. It's going to take probably a couple of years for this to mature. There's a lot of initiatives that we're doing. The wallet itself is progressing. We have a MetaMask snaps where people now, anybody can build add-ons to the wallet to improve the user experience in a way or another. So there's a lot of work to be done. And until that work reaches a certain level, we will have to somehow trust the CeFi protocols that they are layering on top of these financial products. They're taking a cut, of course, hopefully doing what they say they're doing with the money of the users. But if they don't evolve themselves, like in 2 or 3 years, the DeFi protocols will take that business back. Like once you have validated theories in terms of what financial products work for peer-to-peer trading and DeFi and whatnot, and then they have that maturity to build apps as easy to use as Facebook on top of those financial products, then I wonder what an exchange will do at that point, other than maybe KYC regulation and on-ramp, off-ramp of the currencies. So yeah, keeping an eye on what's the innovation happening at the exchange level, what's the innovation happening on DeFi level, how they compose together today, and how they're going to go together 3 or 5 years down the road. What would be the picture in that space?
Yeah, so I just want to add, and I think that point is really great actually. So for the better part of the past 2 years, right, the blockchain and crypto industry has kind of like underwent a hyper growth kind of model where everything and everyone was looking inside, valuations was like $1 billion, $3 billion, and then even for the small companies, you were looking at $200, $500 million. I would say that hyper growth has actually produced a lot of yield because the money was actually gushing into the industry in general. And when you have so much money gushing in, your organic yields could be as high as 30% or even 70% when it's just cold hard cash, right? The problem with DeFi is that for the whole phase of its maturity since it was just a baby, it has not experienced the need to compete with a real yield environment. And that actually struck really, really heavily when the Federal Reserve started moving those interest rates up an inch, and it started went to like 4% and 5% right now when it's actually affecting physical markets. So what I mean by that is when the Federal Reserve increased interest rates from almost zero to what right now it's around 4%, there wasn't a way for DeFi to get that policy transmission into its ecosystem because for the better part of the past 2 years, you actually had hypergrowth from free money anyway. So right now, what we are trying to solve at Algorand is we are trying to build out that curve, that yield curve that everyone in the physical world actually has to respect. And what I mean by that is we actually have several applications that's focused on real-world assets. Applications like, example, ShipFinex that you guys saw earlier, that's bringing real-world assets onto the blockchain as an option for users to invest in. So we actually, on Algorand, we actually have a real estate investment platform right now, founded by a guy that's graduated from Y Combinator. He offers a range of 11 to 19% on Algorand. But what does that mean, right? That means that nobody's actually really covering, the 1 to 5%. And that has been one of the major challenges, I would say, of DeFi right now. Because when you are looking at someone covering the 1 to 5%, it's tricky because you can't just bring a service provider in to provide a 4 to 7% yield. Whereas on Aave, anybody could borrow around 1.5%. So building out the policy curve is one of the trickiest things to do right now in DeFi. But like what he has shared earlier, once we get that done from all of the service providers, all of them have US legal opinions, built out their own parts of businesses, then we will have a full curve and DeFi can actually, users can actually interact directly with DeFi through all of these businesses and actually flourish, actually, yeah.
It's a very interesting insight there about tokenization, and I like to bring that up as a follow-on from discussion here. Now, next year has been lauded and also promoted as going to be the tokenization of real assets year, moving away from the utility concept, so you can actually tokenize, build a coin that is actually pegged or connected to a real world asset that you can derive the value from. ESG is one of them, shipping is another one, diamonds, gold, you name it, we have it, okay? Real estate is also another one. By background, I'm used to be an M&A lawyer. I used to deal with securities. So I'm not going to talk about the securities laws and governance. Let's just divorce that out from here first, okay? Let's just assume everything is kosher, okay? Let's just assume everything is kosher. But what we struggle is that is the valuation that is being attached to a real world asset that can fluctuate as well because of context. And how is that connected and how is that hedged and managed on a token where it is connected to, but it is now on a secondary market? And then of course, we will go back to the point of trust, confidence in putting and investing into a crypto token, and essentially which is going to be yielded in a DeFi market. I mean, thoughts?
Yeah. So really quickly, right, I would say that that's one of the major things that a lot of blockchain natives are uncertain about, because when you look at the valuation or just prices within the chain, there has been a preference for non-real assets. That means purely digital. So, example, Ethereum is not tied to any real assets. No, when you look at Algorand, it's not tied to any real assets. When you look at like for example, Bitcoin is also not tied to any real assets, and that's actually an advantage. That means that there's a speculative value. It also means that you do not need to be anchored to anything, like users and the free market gives it a certain value. When you tie it down to the real world, things change. So for example, going back to the curve that I was speaking about, right? If somebody offers, for example, a TIPS, Treasury Inflation Protection Security that's around 10% right now, coming from the US Treasury, you actually need an intermediary or a digital services provider or payment services provider to actually recognize that that's legit on the blockchain. What I mean by that is, if you had a representative NFT of that bond on the chain, and the person holding that bond goes away, right, then you essentially have nothing. That's actually the biggest fear that a lot of people from within blockchain is actually afraid of, like when the liability strike and everything just goes away. So I would say that like it really takes a Herculean effort, right? And this is where like I think Consensys is really doing a lot of on that side, where we need companies and banks and BFIs in real life to first push through with their digitization first. You have to complete your digitization first, then start to incorporate Web3 elements such as blockchain and AI. The reality right now is that a lot of MBFIs, FIs, as well as just banks, right, in general, are still in midst of their digitization. And I know this because I actually spent a couple of years at Deloitte Consulting, where it's a multi-year thing, and it takes like 8 years or 15 years or whatever, and a lot of money for that to be completed. But it's really because of their systems being so complex that they will have to take that much time. But there's going to be a sweet spot around 2023 to 2025, where a majority of this financial digitization is going to be completed. And I think that's when it's going to get super exciting, because that's where you can actually have a consulting company like Consensys come in, plug everything in. And
the one thing that I disagree with is that it's not going to be done so quickly. Part of the reason I came to Bangkok here, I have a small bank account, so my phone number expired, and I have a digital banking app that I wanted to update with a new phone number. I couldn't do it online. I went to the bank, waited 2 hours. I've been told, actually, this is not the right branch. She wrote a document in Thai, sent me to another branch. Went there, updated the phone number. I was told that I will receive an SMS in 5 days with a new phone number. Then I have to go to a branch to set up the app again, right? So this is not going to get solved in 2 years. But to go back actually to the tokenization of real asset, there is a lot of interesting projects that are taking a particular asset and saying, well, we have the proof of reserves of that, so I own the property or I own the maritime shipping, and I'm going to create a token, and I'm going to have people trade on this token. The limitation that today is still making these projects struggle a little bit is the liquidity, right? So you have the tokenization, but nobody's trading it. You have like maybe 100 investors, and the price does not fluctuate enough. It cannot be interesting for you to do arbitrage or do some composite products on it. And to show you a little bit how this journey also is going to take time, let's take a simple example, right? So which is FX trading. Today, if I want to do FX trading, I probably can just go and get USDC, and I think Circle is launching or launched already a Euro C, right? And so we have one pair already. We can do some trading on the blockchain, instant, probably on some decentralized way without intermediaries. You can do leverage, perhaps there were some products. Then USDC probably going to take another year to bring maybe Singapore dollar, and then you'll have 3 pairs. And so it just takes so long for a company that has the volumes for liquidity. So you need those large volumes to have the liquidity trading, to get the regulatory approval, to get the trust from the public that we have the reserve, and then to have the app builders to go and build a couple of protocols on that to offer you a trading. So it is a dilemma. I think from a technology point of view, it's very feasible for me today to go and take a building. I think in Consensys we did this like 10 years ago. There is a project in Paris that has that, but nobody's going to trade it. It's just not enough, right? And then you have to prove the reserves. And so perhaps an interesting angle would be some government-led projects. So recently, I think in Singapore with the MAS, there was a FX trading done on the blockchain. That was, I think in Japan yen to USD, if I remember correctly. And so that was still a pilot, but once that's pushed into a higher scale with higher volumes, that could be an interesting project led already by the regulator, leveraging the technology of blockchain to have these fast transactions, low fees, instant views on the chain to do the trading. But then, again, I'm being realistic here, so it's good to innovate in these projects where we're tokenizing some assets, but there is a few things to work on, which is the volumes, to have interesting use cases, the composability, where you have people coming and building on top of your token and building their dApps, their DeFi protocols there, and then obviously maintain a level of trust that you are indeed holding and in control of those ones. So perhaps, I mean, oracles today can do some of that job, but perhaps like an intermediary, like a regulator in between could come in and say, well, we are the tokenization authority of Thailand, that if you want to tokenize a real world asset, you have to come through us, and then we can prove that you indeed own it and whatnot. So there is still some work, but at least we know what is the work that needs to be done.
And that's where it comes to the crunch we were discussing earlier on, and I was also discussing with a few members outside there. Okay, as a builder, and coming from a traditional finance background and now moving into DeFi, I always notice that there is a major clash between DeFi and CeFi, and it is not actually on the it's not actually the space and industry. It's actually the mindset and the psyche. So you have the DeFi purist who basically believes in the product and purely in the product, and therefore will not adapt and change when all these things are moving so fast, regulations is one of them. So, and this is what I observe, that a lot of all founders and products and companies that is basically built on this kind of basis tend to wash out in markets like this. Product is great, okay? So I like to, you've seen a lot of founders, you've seen a lot of, especially, Algorand, you've given grants and other, you've seen a lot of, you work with them, and you've seen other cycles. I'd like to get your perspective as well, and what you think about that. The other thing also, if we have time, we're trying to slot in also the discussion on incentives mechanism, which is very, very prevalent in DeFi. But let's talk about the mindset on terms of DeFi product versus the uniqueness character on the CeFi space.
Yeah, okay. So maybe I'll share a little bit more. So I would say that the personalities on DeFi, TradFi, and CeFi, it's all really very different, right? You have problem solvers sitting on the CeFi side. On the TradFi side, they're trying to look for, I would say, fees and kind of like optimizations on their platforms. And then on the DeFi side, you have what we call, like what you say, maxis, right? Maximalists that's just trying to use the math that's available on chain to try to give them some sort of solution, and they only trust the on-chain side of things. And when we speak about founders, right, and that's one thing that I actually really notice about, where the founder usually comes from a certain background, and they usually have a framework as to how they view their product. And I would say blockchain and crypto is really very tricky because people come from all sorts of backgrounds. If you were a trader at Nomura, for example, you will come with that mindset of enabling Forex and collecting fees off of that. If you were some of an art student, from the art scene, you will bring and you will think about creating an NFT collection. That part, right, it's very hard to change for a lot of people. And it's, to be very frank, very tricky for someone sitting within the industry to collect all of those experiences. You had to have, for example, a perfect resume of a founder or somebody working within the industry will be 5 years at a TradFi bank, 5 years as consulting, 5 years with Google, and then the last 5 years. So that person would be probably done, by the time they have collected all of their knowledge. So that part's really interesting. The second part is about valuations that you were speaking about, right? I think that definitely has to come down. So I was saying that we were raising like 5 billion, 300 million and $200 million. And when I turned my head, right, during this downturn, and I looked at valuations on the fintech side of things, I was like, what? They are so cheap. Like, it's actually nuts. And I think there is this realization coming from the industry as we are looking outwards that a lot of things will have to change, and it's going to be a very tough process when that happens, actually. Yeah.
I'll add just one angle. This is something. So I've worked in tech, Web2 tech for a few years, and then in the Web3 space, the one thing that caught my attention is really how it is a space that is so small, right? So small that it doesn't make sense to go and compete against each other. And this is one thing that will help us actually survive as an industry, whereby if I am a founder today and I have a technology or an idea or something like that, building actually walls around it that makes it closed source, not integratable, locked in, you either use my solution or you cannot go anywhere else. This is actually, fortunately, this is not what's happening in the space in most of the projects. Most of the projects are open source. The smart contracts in their nature, you can see what they're doing and you can maybe fork them and do what you want. You can fork MetaMask and try to build your own as well. And this is really what allows the space to grow and continue. So even if I come and build a DeFi protocol that has a good aspect in it, I can tomorrow maybe run out of money, but the software will still be there. And you can actually take it and somebody else will carry the ball. You can push it into a DAO and then let the community grow with it. And it's not something that depends on you as a founder, as a person. And so there is a lot of these people who have, founders in the Web2 and the fintech space and whatnot, usually are, one of the qualities they have is their ego, right? So they have to believe that they know what is right to do, they are the best people to do it, etc. In Web3, it's not required, right? So you have a good idea, you have a good team, you create a good piece of software that people can build on top of, they can fork it and whatnot. And then as long as it's open, I think we'll be safe in terms of like continuation of the dependency on the founder, on the person. And to circle back, that's exactly what getting the CeFi in trouble, right? So we have so many prophets, false prophets coming in and saying, trust me, I am a genius person, and then it becomes a bit of a cult movement. Ideally, in a fully decentralized Web3 economy where software is king, we don't need to rely on people or on a particular founder. People can come and go, but the software and the proof of what the software can achieve and what you can build on top of it, that will stay on the chain, and we can continue building on that.
Thank you. So I'm going to now push it forward and look at the future products and the things that is happening on the DeFi space. That is a strong push there. So I'm going to ask your thoughts about incentives, mechanisms, layers, which is largely built on a lot of protocols to create volume and create volume, and also the quality of the utility. This is a huge thing in DeFi because staking and hodling is actually killing DeFi. And also, I'd like to also gather your thoughts about new concepts, which is basically reputation value captured in the form of soulbound tokens, as a new way of probably introducing an under-collateralization of liquidity pools. Because generally, right now, just based on concept, a lot of pools are over-collateralized in order to protect itself. But if you have a reputation value token that acts like your credit score, technically speaking, you can't under-collateralize the token because you have a reputation scoring that back you up. And therefore, by doing that, more people can come into DeFi. What do you think?
I'll comment on the first one, which is perhaps one of the things that attracted me most to tokenization and blockchain and whatnot, is really the ability, the key value of blockchain to me is that the ability that we can take an illiquid asset and make it liquid. Take something that all of us are holding in our back pocket, whether it's a hotel booking or a flight that we bought or a concert ticket that it has no value unless I know a person that I found online to buy from me, and make that a liquid asset and make it tradable, potentially create a secondary market and create movements around it and create wealth generated by building on top of that asset. Now, obviously, if you go into a staking universe where people hold and lock the asset, that kills a little bit the movement on the liquidity. And so there is a lot of initiatives, as you said, that are looking into how we encourage people to trade, to move it around, right? So there is a few experiments that have been tried, and distributing rewards and whatnot, and staking rewards. So far, I haven't seen something that is 100% successful, but I'm sure a lot of people are building, and it will be interesting projects to follow.
Come to Floodity, we're building it.
I'll check it out. Now that I know, I'll check it out. And so that's really the first one. The second point, which is around the okay, how do I minimize the collateralization? There is interestingly actually a couple of projects who are building what you would think is a credit score, right? So a reputation. And soulbound token, for you who don't know, it's a token that you can attach to somebody and it's non-transferable, essentially. So it represents your history as a person, what you've done, is a great medium for us to carry that credit history with you. The one thing that I will say about that space is that, again, for us to succeed in building that, we'll probably need one credit score that we all trust. And today there is a lot of builders of credit scores. And so it's interesting to see how will they innovate, how will they collaborate, to come up with something that is probably, I don't have to check 3 credit scores, I check 1, like the FICO credit score, and I'm good with that. One of the dilemmas that I saw with these projects is that should I open source my code or should I close source my code? If I open source my code, it makes my credit score a bit more trusted because people can see how I'm calculating and how I'm seeing it. But if I open it, then somebody else will take it and run it. So again, it's an interesting space. If you are investing in the space or looking to build into it, I invite you to take a look at it because it will drive minimization of collaterals in the protocols.
I would say that, I mean, just on a second point, right, like credit and under-collateralization is something that's going to be pretty important because just to speak to the incentivization side of things, right, I think when a application is kind of like giving out tokens for free for you providing liquidity, within the industry, we're actually quite renting liquidity. Essentially, you are actually providing your liquidity at a specific point, and they give you tokens or whatever with a certain value that's attached to it, right? So they're actually renting it from you. So the thing is this, the thing is renting liquidity can really only do well when the central bank has interest rates at 0%. When interest rates are at 5%, and your fixed deposits is competing with your, essentially your savings account. So in Singapore, before I actually came to Bangkok, our interest rates hit 5% for just a savings account, no, just deposit your money and it's 5%. So how can a platform actually give you enough tokens, right, to fight with that 5% plus inflate their incentives, right? So it gets very challenging on that side of things. That's where I would say a lot of platforms will actually have to look towards other forms of credit, and under collateralization is actually one of them, because it creates credit within the space, and credit allows for other financial activities to take place behind it actually. Yeah.
How are you building the reward system?
Oh, essentially, okay, I'm not allowed to show here. Just check out fluidity.money. Yeah, I'm really interested in this one is because I've always felt that savings is it's a privilege. You need money to save, but spending is not. It doesn't discriminate. So we took that concept and basically incentivize people to move because you need to spend. Spending is what? Is moving transaction, moving from one wallet to another wallet, moving this. So I know they're blinking the lights here. So I'm going to stop here and just want to throw it to the crowd. Any questions you want to direct to the panel up here? Any questions? Yes, please.
But we know that the soul-bounded token is only connected to the wallet and is not connected to the people. But the reputation should be belong to the people, right? So how do we solve that problem?
I think some projects are working on like proof of humanity to show that actually a person is attached to the wallet, and then by translation that could relate to the soul-bound token. I would also argue in some cases I only care about the wallet. I don't care about the person because the wallet could represent a DAO, could represent an idea, could represent a smart contract. So I think there is two use cases, right? So do I need it to be a person or do I just need it to be a wallet? The second case is easy to fix. The first one, there is a bit more work to be done.
Yeah, and just to add on, right, it's how savings accounts actually work, right? So my mom could access my savings account, she could take my ATM card, withdraw money out of it. So I think it has the same logic actually.
Lucky.
I still got 2 minutes, so I'm going to throw it to the crowd. Anyone? Anyone? Yes, thank you.
Protocols like, for example, I wanted to ask. Okay, it will be better right now. So I wanted to ask about the open source protocols, like, for example, Tornado Cash, because right now we got a case that they would like to take the programmers as a guilty persons for someone else to using decentralized financing for some crimes or something else. So what's your opinion about that and how it can affect the decentralized financials?
There is a great article written by Bill, who's part of the Consensys legal team, that really talks a little bit about money crypto and tech crypto, and how regulating one and regulating the other is not the same thing. And so unfortunately, the regulators moved on Tornado Cash, and actually they regulated the software. So they regulated tech crypto in a way. But money crypto uses tech crypto, and tech crypto to grow needs money crypto. And so ultimately, I think regulation will hit them both together. There is an effort by organizations to go and speak to the regulators, to share with them the difference and make them actually make the right decision when it comes to regulating smart contract versus companies and whatnot. Unfortunately, the people who did most of the talking with the regulators are the FTX people, apparently. And so this is really, I think, a leap of faith from our side into our regulators to hope that they should talk to all the parties. And then I think associations in certain countries, for example, Singapore, we have the Blockchain Association, just brings some industry players and takes their voice to the regulator. It's not an easy way to fix, but ultimately this is what we need to do. We need to educate about the difference between software and digital assets and how you can regulate one without hurting the other. And then, you know, unfortunately, the way we're building like privacy and whatnot with Tornado Cash, it just conflicts with what governments want to do. So perhaps another version 2 that will be a bit more usable.
Do you want to add? No? Okay, then this ends this panel. Thank you so much for listening to us. Thank you.